Mark Selby. Good morning. How are you, sir?
Mr. Matthew Gordon, doing very well.
I'm glad to hear it. Glad to hear it. Hey, look, we're going to rip through this because I think you've got places to be, and we better start with price. What's happening in the market at the moment?
So again, another week where we're trading in our $20,000 to $22,000 range. This time a little lower, just about 20,500. But again, holding in very well. This break that I thought would show up really hasn't showed up materially. So, I think that's a good sign. And LME inventories remain multi-year lows. I think that what the market's waiting for is some clear direction one way or the other. Again, despite all this bearish news in the market, I think as we talked about a little bit on last week's show, we're seeing real strength in stainless markets in China. Production is up significantly year over year. We're seeing both NPI prices and stainless prices moving higher, which again, I expected that later this year, but not seeing now. And so, again, I think that, bodes well for, overall stainless demand when we're seeing that in China. On the battery markets, again, sulphate's still treading water a little bit. So I don't think, until we see that really rebound, I don't think you're going to see anything move much higher. But again, as EV sales, continue to re-accelerate through the rest of this year, I think, I think we'll start to see some action in that market as well. Still holding out for a end of year rally, November, December, in terms of nickel prices moving higher from current levels.
Right, and obviously we talked in the past about nickel, copper, and the whole kind of EV group of metals, pretty much following each other. I mean, I think maybe lithium had different ideas for a bit. How do we read what's going on in China in terms of people are concerned about a reset, they're concerned about the economy there, they're concerned about some of the companies that previously were getting a little bit of assistance from the Chinese government? How does that affect the nickel market?
Yeah, I think the key thing here is nickel has a broad range of uses. Two, stainless steel and nickel have always been higher price materials, and so as you move up the value add curve, you end up using more nickel and more stainless. So I think what we're seeing here and some of the strength that we're seeing, in the Chinese market is the fact that this move up the value added curve is overtaking sort of the broader issues, in the Chinese economy. So I think it just sort of points to the real sort of underlying strength in stainless demand going forward. And as we've talked about on many shows, I think that's where we've seen 5 or 6% growth historically. Most analysts going forward always use 3 to 4%, and we end up at 5 to 6%. And I think that this kind of information really underpins that, getting to 5 to 6%. Again, right now globally, with Indonesia industrializing, again, we're starting to see India, Indonesia, and the rest of Southeast Asia sort of, picking up, some of that growth that was originally occurring in China before. So, concerned about, some concern about China, but I don't think it really disrupts the nickel picture, over the next 3 to 5 years here.
Okay. Well, I guess you're off to Korea in a little bit as well. You can tell us a little bit about how they feel about things. When you get back.
When I get back, yep.
When you get back, absolutely. So let's absolutely. So, but let's go local. Let's talk about Canadian nickel. SPC Nickel. We've much talked about buying us. Well, what's happening there?
Yeah, so August, obviously things quieting down in news front as investors are fairly quiet. But again, it's good to see SPC Nickel. We've talked about them before. Again, relatively low market cap, but I think they did a great job consolidating. With what was effectively two halves of a deposit that was owned by Vale. They now, there's a structure that they have 100% of it, with Vale getting, a chunk of the economics. But again, great intersection. They put out a bunch of drilling there. The best being 18 meters at 1.27 nickel, 0.47 copper within 50 meters, at low grades. Those are all very mineable widths. And so, we'll see how that deposit develops, but again, good to see it, and they're run by a very good group of explorationists. So, looking forward to see more results come out there for sure.
Well, and it seems to be not to be left out of the picture. Obviously, Magna Mining, again, another company we've talked about a lot recently. What have they been doing?
Yeah, so Magna, we talked about the PEA, that they put out last week, and one of the things to keep an eye on is Magna and SPC Nickel aren't too far away from each other on the basin, so there'll be some sort of consolidation space in the North America in the Sudbury Basin between some of these properties. So we'll see what happens in that front. So again, as SPC Nickel continues to advance, wouldn't be surprised to see somebody kind of put their finger on them at one point in time. So
well, when it comes back to something we talked, it's lots of things we've talked about before, Mark. It's surprising after 3 years how we repeat ourselves, but it's worthy of repeating, which is scale is going to be really important for industry, for funders, etc., to be able to kind of see long life of mine and be able to kind of I guess amortize that capital expenditure that's going to be needed over as long a period as possible. Canada Nickel, you've made an announcement about the Man Northwest discovery recently. So tell us about that, because I've got a few questions I want to ask you about.
For sure. So, we announced this the end of last week. We're stepping out around our property package. And again, we've got Crawford, and then we have 20 other targets in the region. Man Northwest, we're doing very wide space drilling just to delineate sort of what the potential, whether the potential really is there. And again, very happy, 2.5 kilometer strike length of mineralization, that we've outlined. We had hit the right kind of minerals, the right kind of, and we're very happy with the grades. Now, it's mostly peridotite, which is of the dunite and peridotite that we have. The peridotite is the lower grade material, but it was well mineralized and good, decent grade for that type of that type of mineral. The good thing is again, in terms of scale, within that 20 plus targets we have, 11 of them are larger than Crawford. So, Man Northwest is more than 3 times the scale of Crawford. So, when we talk about putting together an entire Timmins nickel district, with the potential to be bigger than Sudbury, it's targets like this that, really can have the potential to, substantially add to the resource, that we've got there. So again, very exciting results. We've done a half a dozen other where it's Reed, Sothman, Deloro, Bannockburn, Midlothian. As we go through, we've got nearly 100% hit rate on these targets.
Right. Okay. But coming back to that scale component here, which, and again, we get a lot of inbound about what you're doing there, and I know obviously there's a feasibility study coming up as well for you guys, which people are eagerly looking forward to. But the scale has been a big part of this message from you in terms of the way that industry views these sorts of discoveries and how what attracts them, right? So you've got Crawford, which when every time we've talked about it, we recognize it's a top 5 scale project in the world, but you keep finding more. You want to talk about this sort of district wide potential here. Does that give you optionality in terms of financing? It gives you optionality in terms of who you talk to and how you kind of separate out all of these assets, because presumably they can stand upright on their own, each one of them. You don't need to develop all of them together, right?
Oh no, for sure. So that's the piece here. The having basically having 20 chips in the game, where most companies only have 1 or maybe 2 chips, gives us a huge amount of flexibility. So when we get to the point here where the market fully recognizes that these kind of deposits are going to be the next generation of nickel supply, that the market needs, we all of a sudden are sitting there with 20 chips. And so, the only thing major mining companies like more than one big mining project is an entire new big mining district. So we've got that. And then in terms of flexibility, in terms of, do we do something with Crawford separately? Can we do something, with one of the properties if people are really interested in that? Can we do something with a group of the properties that are a natural collection there? So, there's a whole wide range of different ways that we can play it. And again, it's all about, creating financing, creating value for shareholders in a way that's the least dilutive possible for them. So, having this portfolio is going to be a tremendous benefit. And again, we're only getting to the point now, once the feasibility study comes out next month, that we'll be able to really demonstrate what the potential of this district is going to look like.
Right. Okay. And obviously, having worked in 8 holes at the Man Northwest property, presumably now you've got to kind of gauge the market reaction to the feasibility study coming out on Crawford. You've got to gauge how you allocate capital and the return on that capital you invest across these various properties, because I would suggest that the market's looking to you to kind of get something over the line before you go spreading all of these dollars across what may be eventually one of the biggest nickel districts in the world. So what are the discussions, conversations, and quite frankly, key variables that you're looking at?
Yeah, no, for sure. So, the key thing, as again, someone who's most of my net worth is involved in the equity of this company, it's really about, if we really haven't got full value for the first 2 billion tons of resource that we've identified, why spend a lot of dollars, drilling off that next billion tons or 10 billion tons of resource that's there. So, the key thing for us right now is really just doing some very wide space drilling, confirming that it's not just a geophysical target, that, the kind of mineralization and kind of nickel grades are there. And again, we've been clear to the market that we're doing this because if you get into a hostile takeover situation, if you look at valuations, if you're a good project, you tend to go out for 0.8 to 1 times your project NAV. If you're a good project with a lot of exploration upside, you end up going out for 1.2 to 1.5 times your NPV. So, that's what this program's all about. And until we see, a significant re-rate in the value of Crawford, we're really not going to spend too many dollars at this point, hitting that other, anything other than this white space drilling that we've been doing so far.
Right. Okay. And and obviously I'll mention the fact that feasibility studies coming up, incorporating carbon capture and storage, etc. So all good news. Not all economic studies are well received, though, Mark. I think we've seen that in the market this week. Poor Chalice Mining. What happened?
Yes. So I'm going to be a little bit hard. I'm, again, generally not try to be too critical. As I said, we've need all the nickel, and this is now turning more into a palladium deposit than a nickel deposit. So, and they had a market cap prior to the announcement of about 1.8 billion Aussie, which is about the sum total of the rest of the nickel developer sector in total. So, they've come off about 30% since their announcement earlier this week. The PEA had what I would call offensive assumptions, not just aggressive, but offensive. Again, we pick up the news release, the headline numbers all look great, but then you dig into it a little bit and you realize, oh man, there's some pretty aggressive assumptions in there. I just want to
so we want to be clear for people form an opinion about it. You mean offensive as in, you don't mean that as in let's go on the attack. You mean that as in it is a bit ludicrous, some of the assumptions.
Yes, 100%.
Okay.
Yeah.
Okay.
So it's not helping the entire mining industry convince investors that we're a rational group of people who they should trust with large sums of their capital to do things with.
Okay.
Yeah.
Sorry to interrupt, but it's worth clarifying.
Yeah. And the key thing I just want to highlight, we've talked about this before, with PEAs, but I want to make sure that people doing this are very clear on this point. A PEA is only as good as the engineering firms that are signing off on the report. There are dozens of engineering companies that actually rarely, if ever, built any of these things. What they do are studies. And guess what? How do you do more studies? Make sure that those studies are pretty good for the mining companies with whom you're writing the studies for. So that way they'll choose you again. Because I don't know how many times when we started Crawford, when we put the PEA out, my past life at Dumont, I hear from investors, oh, well, I only like something that has a mid-20s, percent IRR. And, again, a lot of those kind of results come out from, bad operating assumptions, bad capital cost assumptions, again, a bunch of just nonsense, underneath it. The reality is if you're getting a mid-20s percent IRR on a project, it's probably precious metals. It's probably small scale and high grade, and it's most likely in a high risk jurisdiction where the government might take that 20% IRR. So if you don't own it anymore, the IRR on that project is zero. So, if you're looking at base metals, large scale, in a place where the people won't take your asset, with a few exceptions, you're generally looking at a mid-teens IRR. Again, having worked at major mining companies and looked at lots of big projects in my past, that's the real market. So you should almost, if you end up with a project with a mid-20s% IRR, you should have some warning signs, because there's a whole pile of assumptions that go. And we talked about this a bit on last week's show. Some people were pushing on some of the assumptions we had in our PEA. The reason too that I like to look at Chalice is the Gonneville, which is their big deposit, was discovered right around the same time as Crawford. So it's a very useful benchmark in terms of how we're doing versus another project. Now they're about a scale now. Is the biggest one that they're looking at in their PEA is about 1/3 less than Crawford, and their mine life is half of what we have. You're likely going to have with the resource we have, in the feasibility study. So first off, they're publishing a PEA, which we did in May 2021. A month earlier, then we'll have our full feasibility study out. They won't get to their full feasibility study until 2.5 years from now. So again, when I've talked about, the fact that we've gone from 5th drill hole to feasibility study in 4 years, they're doing the same thing, in a very comparable place in 6.5 years, so 60% larger. But the key thing here with these PEAs is there's a whole pile of assumptions that are in there. And, when the price deck, right, this is the most visible set of assumptions that people can see and look at and have lots of public benchmarks to see whether they're real or not. The palladium price was $2,000 an ounce. Today's price is $1,200. Remember, palladium's main use is catalytic converters, which are, slowing down as electric vehicles come on. The nickel price was $24,000 a ton. We'll be looking at something, 10 to 15% lower than that, closer to where we are in today's market. Copper price was $11,000 a ton. The copper price has never been this high, right? And so, they had a wonderful NPV and IRR headline numbers, but, I think I haven't seen any analyst reports yet, but yeah, I think looking at their sensitivities, you get to a point where the NPV for the project at today's prices might be close to negative, or several $100 million. And again, they still have a $1.3 billion market cap. The other thing that's pretty interesting, CapEx. So, again, as I've said, our feasibility study CapEx is going to be about 50% higher than the 1.2 billion that we had in the PEA, so 1.8 to 1.9 billion US. Chalice, in their CapEx number, they're getting a 1/3 bigger mine mill operation in their upside, larger scale case, a leach plant, a hydromet plant for 10% less CapEx than we're spending for our first phase project. And this is in a place that's a higher cost jurisdiction in Western Australia than we are in Ontario. So again, some of those very simple things imply a bunch of aggressiveness, and so who knows what else is behind the thing there. So again, very, very disappointing, in terms of what's come out, and again, not helping the industry, sell the industry to investors. So.
No, because huge value destroy for retail investors yet again. I think it's even worse than 30% today, just looking at it, heading towards 40% value destruction. But how does a company get out of this? Because clearly they've laid out their wares, they've laid out the price tag. Everyone can sort of see that they are being presumptive about future price, and that's a strategy I've seen other CEOs, make the decision on, or boards make the decision on. But it feels like there's got to be more to it than just hoping and waiting for the price to change in their favor. Metal supercycle, we agree, the prices should move forward. But to make those assumptions at this point, do you think companies? How do you view that? I mean, how do you view that? So I just get quite tough here, but I'll let you.
Yeah, I think I think they'll see their. I mean, it's amazing what prices will hold up for a while, but I think you'll see institutional guys, exit the story, and as the price comes down, they'll either going to have to come back with a new PEA that sort of resets expectations in a way. But I think given what they've done here, the chances of that are small. I think it'll be, the next owner of this asset will come out with a, after the share price has fallen down enough that the next owner of this asset will come back with a, reasonable study that's there. Again, they had such a good kudos to them to get the market cap to where they were, but they were, I think, trying to backfill the market cap with the with these PEA numbers. So
yeah, not good.
Good.
Because again, when I constantly say to people, right, you need to identify companies with kind of strong fundamentals in terms of their ability, in terms of revenue and earnings growth and profit margins and debt profiles and cash generative potential and returns on that capital invested, which is should be the ultimate arbiter of all of this. It's a bit harder when companies are going to go to that development phase as they are now, but it also says to me, I'm not quite sure why the prices run as much as they do until those things get demonstrated in some kind of economic study. So here we go, yet again, it's not the first, won't be the last, but there we go. No, Mark, conscious that you've got a hard stop, you've got to get going, and I'll let you do that. And unless you want to kind of finish off with anything that we should perhaps leave as thought for the day.
Yeah, no, would be good to talk in a week or so after I'm back from Korea. I'm talking with a lot of the key members in the battery supply chain, and we're making good progress on multiple fronts there. So be a good sense of what's happening in the market there. And so looking forward to the next chat.